Okay, so good afternoon, everyone. Good afternoon. As promised, I am here to do a discussion on a path to smarter investing, or the path to smarter investing. Now, understand that I have an hour, so this live only allows you to go an hour before it cuts off. So with that in mind, good afternoon, good afternoon. So with that in mind, I'm going to cover as much of this as I possibly can. And whatever I don't cover today, I will pick up on next Sunday. Okay. So I would ask everyone to try to hold their questions till the end, because I am going to leave a little bit of time, or at least try to leave a little bit of time to answer some questions at the end. So please, if you can, hold your questions till the end. I'm going to give people about a good minute or two to get in here. And then I'm going to get into this. So that's kind of that. I got my water on deck today. You know what I mean? So if I feel like, I need a little sip of water, we got that on deck. So I'm ready. With that in mind, I'm going to give it about another minute. And then I'm going to go ahead and jump right into this. I got a lot to cover. And I think that this is gonna be helpful. At least that's the hope. We shall see. Okay, so let's give it about another minute, and then we're gonna go ahead and jump into this. Oh well, gee, thank you. I thoroughly appreciate you. Thank you. I'm doing good. It's a great Sunday. I see everybody getting in the building. So we're gonna get started in about another 30 seconds here. I'm gonna jump right on into this thing. So that's that. I'm actually excited to be doing this course today. I'm pretty excited about this one. What's good, Mr. Hoskins? What's good? I think you guys will find this one to be very informative and very helpful for you moving forward when you're evaluating certain types of investments, or just investments in general, right? So, thank you. I appreciate that. Okay, let's go ahead and get started. Let's jump right into this. So the first thing I want to cover, I have a list of talking points that I've put together here for this. So the first thing I want to cover is the goal of investing. And I think it's very important that we get an understanding about what the goal of investing really is, right? So most people think that the goal of investing is to just make as much money as you can, or make some money on your money, right? And that is part of the goal of investing. That is part of it, right? But there is an even more important part of investing than that, because there's two parts to this. So on Wall Street, this is how we say it, right? We say the goal of investing is to maximize capital appreciation while mitigating its risk to its lowest common denominator. Now that sounded really, really, really complicated, right? So I'm going to simplify this. The goal of investing is very simple. Make as much money as you can while taking the least amount of risk possible. And that part is very, 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 very important, right? Capital preservation is key, right? If you cannot get back what you invested initially into a thing, then the rate of return doesn't really have any factor. For example, right? If you invest in something and a person says, in 12 months, I'm going to give you a 50% rate of return on your money. All you have to do is invest $1,000. Okay, that's great. Well, 50% of $1,000 is $500. And so the end of the year comes and the guy says, well, I got your $500 for you. And you're like, well, where's my 1,000? He's like, well, what had happened is really irrelevant at that point, because the net effect of it is you only got $500. You got your rate of return, but you didn't get your principal back. And because you didn't get your principal back, you are a net loss of 50%. Congratulations. That's why before you consider the rate of return of an investment, you must first understand, right, how it is that they are going to protect the initial principle of the investment, the money you give them. That is very, very important. And if they do not have concrete answers for that, that give you the certainty that there is a greater than not likelihood, because nothing is guaranteed, right? But that there is a greater than not likelihood that in the worst case scenario, you can at least get back what you invested. It's probably not a good idea to invest in that, right? So that is the goal of investing. Make as much money as you can while taking the least amount of risk possible, with the number one factor, taking the least amount of risk possible. Capital preservation, preserving the money that you've invested. That is number one. The investment rate of return is only secondary to you being able to reasonably ensure that you can protect the principal you've invested. That's important. Now, let's move on. I want to discuss now rate of return or return on investment, right? So there's some things you got to understand about return on investment that are often overlooked, especially by what we'll consider novice investors, right? So the first thing you want to consider is inflation. What is inflation, right? So we say that inflation is a hidden tax, and you'll understand why that is in just a second, right? But understanding inflation is a very important part of understanding your return on your investment, right? So the U.S. economy currently inflates about 3% every year. 3% per annum, right? So what does that mean, right? Let me explain it. This is very simple. If someone is offering me an 8% return, right? 8% return, right? But the economy inflates 3%, that means my net return or my yield on that investment is only 5%. See, inflation works like this. If I take $100 right now and I stick it under my mattress, or let's say January 1, I take $100 and I stick it under my mattress, and then January of next year I come take it out, in my hand I still have $100. But the truth of the situation, because inflation has happened, I have the purchasing power of $97. I've lost 3% in purchasing power. See, that is the danger of inflation and not being able to calculate inflation properly, right? So there's that. Now, well, hold on. We're going to get there. I'm going to get back to this. Now, right now. So inflation, right, you have to consider that. Before you make an investment in anything, you must have a baseline, what we'll call investment policy, a personal investment policy. That means that you have to determine how much money it is that you want to make on your money every year, right? Because if you don't understand that, right, then you really it's very difficult to gauge investments, right? Very, very, very difficult. So you have to understand first, how much money do I want to make on my money every year? And then once you understand that, then you begin to look for investments that don't have a lot of risk, but are going to give you the greater opportunity to generate your rate of return. Now, so when you're discussing ROI, you must first consider inflation. Inflation is very important, right? So on an 8% return, if someone's offering you an 8% return, once you calculate inflation into that, right, then it's really a 5% return because you got a discount for the 3% in inflation, right? Now, the other thing you have to consider is your personal tax situation. You have to understand how this return is going to be taxed for you, because that amount of taxes, right, goes against your adjusted rate of return, your net adjusted return, right? So for example, right, I'm going to use the Tulsa real estate fund targeted rate of return as a demonstration of what I'm talking about. Now, if the Tulsa Real Estate Fund is offering you an 8% per annum or 8% per year return, right? We'll get to that in a second. 8%. Now, okay, so stated return is 8%. Now, we calculate our inflation in, and it's 3%. But before we do that, let's consider our tax rate. So they're calling this a dividend. Now, this is what the Tulsa Real Estate Fund is calling this, a dividend. Now, whether or not that's a qualified dividend or not, as far as the IRS is concerned, is not something I'm going to get into. But I can tell you this, that different structures represent different things for the IRS, right? So what I will tell you is this. Most funds are structured as limited partnerships, and there's a reason for that, right? The Tulsa Real Estate Fund is structured as a limited liability company. So all of you that have invested in this need to get with a tax advisor and have a discussion about how that tax structure is going to affect you when you go to report this return on your taxes, right? So as far as standard practices in the fund industry, Tulsa Real Estate Fund is not structured according to best practices. But let's just leave that, right? Now, so let's say this is a qualified dividend. Okay, if this qualifies as a qualified dividend under the IRS, the average person, right, is going to fall into about the 15% tax rate, right? So here's how this works. You don't get to take a 15% taxation after inflation. No, your taxes are based on the stated rate of return. Your stated rate of return is 8%. So you need to subtract 15% from that. So if you take $500 and you multiply it times 0.08, that equals $40, right? Now, if you take 15% away from $40, right, what we're talking about here is a $6 cost in taxes, right? Now, you remember that $6. Keep that $6 in mind, because now when you calculate your adjusted rate of return, your net adjusted return, or what we call on Wall Street the yield, right? So what happens here is if you take $500 and you subtract, okay, you got 8%, you subtract inflation, that's 3%, so you're down to 5%. $500 times 0.05 is only $25. But remember, you have $6 in taxes that you have to pay too. So your net adjusted return is actually $19 or 3.8%. So while it feels like 8%, while they're telling you 8%, when you really look at it all the way through, the real return to you, right, based on all of the factors, is only 3.8%. And that's not much better than a bank CD. And that's reality. And for that type of return, that's an awful lot of risk to be taking for that kind of return. It makes no sense. So just based on the numbers alone, right, when you vet this deal properly or vet this investment opportunity properly, right, you realize, right, that just based on the numbers alone, this shit makes no sense. It is a bad-ass investment, right? This is not good for the average African American's investment portfolio, period, right? Now, let's move on. So, when we look at, let's just say hypothetically all the numbers made sense and the returns look good, right? And it's like, okay, this fits my investment policy. Let's just say that's the case. Okay, cool. The targeted rate of return or the stated rate of return is it sounds good. Now we have to dig into the actual fund itself, the investment itself, right? The investment opportunity itself. We have to really dig into this, right? Because this is important. So, when we evaluate an investment, we evaluate it from two places, right? We evaluate it from a quantitative standpoint and a qualitative standpoint. What does that mean? That means we look at it from a number standpoint, and we look at the quality of the people running the investment. Because if I have to give my money to the company, right, the fact of the situation is the company isn't responsible for the execution of the strategy. The people running the company are. So I need to understand what their level of experience is, what their track record is, before I can even consider if this is a worthy investment, right? So we look at the quantitative, which are the numbers, and we look at the qualitative, which is the people, right? So the first thing is, what I care about when I'm looking at people is track record. What is your track record? So if you tell me that you've started a fund, right, and you're telling me you want me to invest my money in your fund, well, I need to ask some basic questions. Number one, well, gee, have you ever run a fund before? Have you ever managed money before in a fund capacity? Have you ever worked at a firm that has funds like, I don't know, Fidelity, JP Morgan, Citigroup, Goldman Sachs, somewhere like that? Have you worked on Wall Street and worked in a fund? Has that ever happened? Because if the answer to the question is no, because first of all, let's be clear. The only place that you get fund management experience is on Wall Street. So guess what? If your ass ain't never been on Wall Street, you don't have no damn fund management experience. Period. So if you have no experience running a fund, right, it would be extremely risky for me to let you manage my money in a fund structure. Why? Because clearly you don't know what the hell you're doing, right? Okay, now, this is a real estate fund, right? Tulsa Real Estate Fund is a real estate fund. So let's walk into this, right? Let's ask some basic questions. All right. So you're saying that you're investing in commercial real estate, multifamily residential buildings, and single-family residential homes. Okay, that's great. What is your track record as an investor? Have you ever invested in commercial real estate before? Have you ever invested in multi-residential development before? Have you ever done that? Do you have documented proof to show me buildings in your name that you have bought, right? That you have bought, managed, and liquidated for a profit in your name, or in the name of a company that you control, that you own. Can you show me that? Because if you can't show me that in your track record, then your track record is zero. So not only do you not have fund management experience, but you don't have sufficient real estate investing experience to be managing my money. And this is all just qualitative. We haven't even gotten to the quantitative yet. We're just looking at the qualitative side at this point. Oh, well, yeah, well, of course, do you have any personal assets? But I mean, we'll leave that and let's just go on your track record of experience of managing portfolios of real estate. Have you ever done that before? Can you explain to me what a discounted cash flow analytic is? Which is something that you would have to use if you're investing in any type of commercial buildings with any type of rent rolls associated with those. Can you explain to me a triple net lease? Can you explain that to me, how that works, right? These are the basic things that we need to understand, right? Yeah, right. Simple due diligence, right? Simple basic due diligence. Basic questions that need to be asked, right? Before you give someone your money. Now, so track record is very important, right? So now, quantitative is the numbers, and we're going to go into the Tulsa real estate filing. I'm actually going to go through the filing, and we're going to talk about certain pages that create issues, right? That should have woke people up and said, oh, hell no, I'm not doing that. Now, when Mr. Morrison here and the Tulsa Real Estate Fund went out saying, we're the first tier 2 African American fund. Okay. So the first question that people should have asked, right, is, well, what the hell is a tier 2 fund? Well, that's a simple Google search. Google Tier 2 fund and see what comes up. And if you Google it, what you realize is you'll come up with, the SEC's ruling on what a Tier 2 fund is. So at that point in time, right? So wait a minute. So at that point in time, now I know what a Tier 2 fund is, right? Okay, now I've learned that a Tier 2 fund is something that's registered with the Securities and Exchange Commission. So now I know that they had to file something with the Securities and Exchange Commission to be able to register themselves as a Tier 2 fund. All right, cool. So now my ass is going to the SEC website and I'm pulling, right, whatever they filed with the SEC because I want to read that. I want to read what they told the SEC, right? This is due diligence, right? I want to read what they said, right? So once I do that, now... So that's not Dub a lot. Please hold your questions till the end, and that is not the topic of this discussion today. That's something that I'll probably cover. Well, some of that'll be covered today if I can get there. Let me get there. So okay, now, so we pulled the SEC filing, right? Now that we've got the SEC filing up and we're reading the SEC filing. So we want to look at a couple of things, right? So first of all, of course, there's an opening page 1, right? So when I read page 1, right, because this is me doing my due diligence, right? So I read page 1. There's a last sentence. There's a sentence on page 1. It's the last sentence in the page. It says, our independent auditors included an explanatory paragraph in the report on our 2016 financial statements related to the uncertainty in our ability to continue as a going concern. Basically, the auditor is saying, hey, we don't believe these people are going to be able to survive. So at that point, this is a badass investment. This is done. There's no reason for me to continue forward at this point in time. Because if your auditors, the people you pay, the independent people that you have paid to evaluate the quality of your business have doubts about your ability to be able to perform, bruh, you not finna learn on my money. Period. You're not finna make mistakes and learn on my dime. I'm good, right? But okay, let's just say you're like, oh, all right, well, that's cool. I understand they don't have any experience, but I still want to, deal with them anyway. All right, well, let's just move to page 2. Page 2, there's a whole sum of our risk factors include we are an emerging growth company with a limited operating history, which means this company's never operated before. So what that means is that, okay, let me understand this. So you're telling me management has no track record. You're telling me the company never has operated before, has no operating history, but you want me to give you $500 of my money. I'm confused. I need that to make sense, right? I think I'd be better off with my dollars in my pocket. You know what I mean? At least I can't be mad at nobody if I lose it myself. So now, okay. Subscribers will have limited control in our company with limited voting rights. So I don't really have voting rights and I have no control in the direction of the company as a shareholder. I'm immediately concerned. So basically it's give me my money, give you my money and trust your ability with no experience and no track record to dictate how my money is going to come back to me. No, hell no, baby. I can't do it. I ain't going to be able to do it. So then another statement, they disclose it again. Our independent auditors have expressed substantial doubt, not just a little bit of doubt. No, the auditor didn't say they had a little bit of doubt. Our independent auditors have expressed substantial, that means a lot of doubt about our ability to continue as a going concern in the independent auditor's report to the financial statements included in the offering. This is the second time that they've told you that the auditor has said, do not fuck with them. Period. So let's walk into that, right? But okay, let's just say, you want to continue to be a believer and, you're like, I understand, people doubt, it's probably because they black. These white folks don't want to see him succeed. So I'm going to go ahead and keep doing my investigation. Okay, so let's go to page 18, right? I like page 18. Page 18 is fun. So let's move to page 18, right? So page 18. So the manager may receive a 5% annualized asset management fee. This is number 3 in the footnotes on page 18. The manager may receive a 5% annualized asset management fee paid monthly to the manager for its services related to asset management. Not its services to making you money. No, for its services in holding your money. So you got to pay him 5% to hold your money? Niggas ain't made no money. Make that make sense. How you getting paid with my money for just holding it? So basically what you saying is, that's like a nigga walking up to you in the street saying, yo, let me hold $500, and for every month that I hold it, every year that I hold the $500 in my back pocket, I'm gonna take 5% out of it. Nigga, are you dumb? Make that make sense. The manager may be paid up to 1% of the acquisition price of a property as an acquisition fee. And that the manager may receive between $850 and $450,000 for this fee. So wait a minute. So now every time you buy a property with my money that you're supposed to be managing, not only do I got to pay you 5% a year, but every property you buy, I got to pay you 1% on top? Make that make sense. Yo. So where does that make sense at? That doesn't make sense, right? So for me, this is a no. This is a no out of the gate. But okay, you like, cool, I understand they need to pay operating expenses, cool, whatever. All right, so we keep reading. Let's go to page 19 and 20. Okay, so total investments, right, that Mr. Morrison has made into the business is $15,350. So basically, they had no ability to operate, no track record, no experience. They've only put in $15,000, which was what it cost to get started. But yet they have no vested interest with you. So they get paid whether you make money or not. For every property they buy, whether it makes money or not, they still get 1%. Period. They still get 1%. Plus a 5% management fee, whether you make money or not. They have none of their own money invested. So they don't really give a shit whether you make money or not. What they care about is y'all niggas keep putting y'all money in here so we can keep getting paid. It's legal because they disclosed it. That's why. You chose to invest. Now what they've done with the money since then, that's the illegality. But that's for another conversation. Now, so let's move on. So from when we get to the top of page 20, we see they have no revenue. They have no net income. It all says zeros. I mean, look, hold on. Let me turn my camera around here real quick so you can see it in the black and white. Zero. Revenues. Zero. Expenses. Zero. Net income. Zero. Earnings per interest, 0. So make it make sense. Make it make sense. But okay, you say, oh, well, they a startup. Of course, they ain't made no money yet. Okay, cool. Okay, well, let's move on to page 21 then, right? Results of operations. Okay, right, 0. Okay, So they tell you we've generated no revenues for the period ending December 31st, 2016 or for the period ending June 30th, 2017. We do not have any current activities. We have generated expenses of $0 from inception to 2016 and December 2016 and 0 for the period ending June 30th, 2017. So we have $15,350 in deferred operating costs, which was Mr. Morrison basically saying, I put $15,000 into this, so as soon as we raise some money, I'm getting my money back. That's what that means. That's what that means right there. But you say, okay, I understand. I'm willing to take all that on the chin, right? So let's go to page 22 then, right? Going concern consideration, right? Going concern consideration. Our independent auditors include an explanatory paragraph in their report on the accompanying financial statement regarding concerns about our ability to continue as a going concern. Our financial statements contain additional note disclosures describing the circumstances that lead to this disclosure by our independent auditors. That is the third time that they've told you that their independent auditors have doubted substantially their ability to continue to operate. This is due diligence. This is what happens when you do due diligence. This is what due diligence is about. You have to do your homework. But okay, you say, no problem. I'm going to keep this going, right? Okay, now let's get into the operating agreement, right? We're going to move down to page 32, right? 32. Page 32. I'm scrolling there now. Now, here's the thing, right? They have a part in here that talks about operating cash distributions. First, okay, except as provided elsewhere in the operating agreement, operating cash flow of the company shall be distributed to the members monthly. Anybody got a monthly check yet? Don't you worry, I'll wait. They bought a building. Anybody got a monthly check yet? Is your check in the mail? Oh, all right. See, because basically what happened is they bought a building, they ain't making no damn money from it. So they ain't got nothing to give. Oh, all right. So long as a member determines it is available for distribution in the following order. Now, first to the members pro rata in accordance with the percentage of interests in the company, whatever, until all members have received a cumulative non-compounded preferred return of 8%. Well, we know that 8% is really 3.8% based on, the actual net adjusted return. But let's leave that. Second, 50% to the members in proportion to their respective percentage interests and 50% to the managers. So what this means is they buy a building, they sell that building, the net proceeds, the profit, even though they have no money invested, they still get to take 50% of the profit and then pay you 8% on the other 50. Make it... Oh my God. Make it make sense. Make it make sense. This is wrong. But okay. You say that's cool. So let's go to page 34 and look at withdrawal redemptions. No member may withdraw within the first 12 months of member's admission to the company. So they have a 12-month lockup period. 12-month lockup period. Right? Okay. Thereafter, the company will use its best efforts to honor requests. Not saying they're going to. They're just saying they're going to use their best efforts. So, okay. So there's that, right? Now. So now withdrawals are not guaranteed to you. They can suspend withdrawals at any time. Members may submit a written request for withdrawals as a member of the company and may receive 100% return of capital provided that the following conditions have been met. The member has been a member of the company for a period of 12 months and the member provides the company with a written request for a return of capital at least 90 days prior to such withdrawal request. The company will not establish a reserve from which to fund withdrawals of members' capital accounts. And such withdrawals are subject to the availability of cash in any calendar quarter to make withdrawal distributions. Only after all current company expenses have been paid. So basically what that means is you can't even get your money out the fund until J. Morrison has been paid first. I'm trying to make it make sense. See, this is the type of due diligence you got to do. And when you do this level of due diligence, right, then you understand why this is a badass investment. But okay. So we can all agree now, based on this basic level of due diligence, right, that this is a bad investment, right? We could all agree in that, right? Everybody agree with that? All right, cool. Check this out, right? Now, let's get exciting. I am a firm believer that most people in the African American community, because they do not have sufficient due diligence level or investment in general type experience, should be investing in ETFs or index funds. Right now, let's run into this. The top 5 best S&P 500 index funds right now. Fidelity Spartan 500 Index Investor Shares. Wait, this is a fund that is owned by Fidelity. Fidelity has a huge track record, trillions of dollars under management. They've got a substantially great management team. But wait, check this out. Their 1-year rate of return, 26.29%. That's a hell of a lot higher than 8%. And it's an S&P 500 fund. Their return over the last 3 years, 14.56%. Their return over the last 5 years, 15.81%. Now consider that. And they're investing in the top 500 companies in the United States that are publicly traded, which is what the S&P 500 index is. Wait. Vanguard 500 Index Fund, which, by the way, the Vanguard 500 Index Fund has no minimum investment requirement. So if you want to put in $1, you could put in $1. If you want to put in $1,000, I'm sorry, that's not true. They have a $3,000 minimum, but they're doing a 1-year 26.24%, 3-year 14.51%, 5-year 15.74%. It's called the Vanguard 500 Index Fund Investor Shares. But wait, even the worst performing index funds in the market right now, S&P 500, 1-year return, 15.77%, 3-year return, 8.86%, 5-year return, 12.08%. Even the worst performing index funds perform better than what the Tulsa Real Estate Fund was offering you as a return, with no track record, no experience, no operational history, no revenue, no income, no cash flow, nothing. Make it make sense, y'all. Make it make sense. But wait. Okay, maybe you don't like the S&P 500. Maybe you like the Dow Jones Industrial Average, right? So the Dow Jones Industrial Average, right? Let's walk through this. The Dow Jones Industrial Average, they invest in companies in the top 15 industries within the United States, right? So, that's, oil, tech, healthcare, etc., right? Now, how about this? The Spider Dow Jones Industrial Average ETF. 1-year return, 20.0%. 3-year return, 10.8%. 5-year return, 12.1%. All higher than a fund with no track record, right? Guggenheim Dow Jones Industrial Average Dividend Fund. Expense ratio, their 1-year return, because they've only been around a year, 17.2%. So even ETFs are outperforming them. Even ETF, Dow Jones, S&P 500, outperforming, period. Right? Now, let me give you some reality, right? When a bank wants to lend you money, they don't lend you money just to lend you money. What they do is they lend you money, and in another class I'll cover this at some point, but they lend you money based on the riskiness of lending to you, right? So there's a risk premium attached to everything, right? So if you have a 780 mid FICO score, you're going to get closer to the prime rate, right? If you have a 620 mid FICO score, you're going to get a risk premium. We're going to attach points on top of the prime rate. So if the prime rate's 4%, you got a 620, we might put 3% on top of that, right? So now it might be an 8% interest rate. So in the same thing, investing comes with a risk premium. The higher the risk, the higher the return should be. Why would you take such risk for only 8%? When you can get into funds that have a substantial track record, substantial performance history, that are outperforming this investment option and are much less riskier and have a lot higher of a liquidity rate. What does that mean? Because liquidity is important in an investment. You are invested if you invested in the Tulsa real estate fund in an illiquid investment. That means that if you needed money tomorrow, it would be very difficult for you to get your money out of Tulsa real estate fund. However, if you invested in an ETF, right, with a higher return, because the market is so liquid, right, because lots of people are buying into it, you can sell that interest immediately in the market and get that money if you need it. But you can't do that with the Tulsa Real Estate Fund because their shares aren't publicly traded. They're not publicly listed. How about that? All this risk for only a stated 8%, which net adjusted only works out to 3.8%? Hell no. Hell no. The worst performing credible funds in the market perform better than they would perform than the money you would get back in their best performing days at Tulsa Real Estate Fund. That's awful. But okay, let's leave that a second. Let's leave that and say, you know what? But I don't want to invest in stocks. I'm a real estate investor. I want to invest in real estate. Okay. Well, if that's the case, then you should have probably invested. Wait, hold on. You should have probably invested in a real estate investments trust. Because a real estate investments trust is not only listed, right? But it is a requirement that they distribute 90% of the profits to the investors. It is a requirement. And guess what? The Site Centers REIT right now, the Site Centers Real Estate Investment Trust, do you know what their 12-month total return is? 32.1%. It's a real estate investment trust. They invest in real estate too. So let's look at Best Properties REIT. Their 12-month total return is 12.2%. Duke Realty, 26.4%. Hearth Peak Properties, 24.5% over 12 months. These are all real estate investment trusts. But as it said, you don't know what you don't know, right? Which is why we having this discussion right now. This is exactly why we having this discussion. Because a little bit of due diligence, a little bit of the right questions would have prevented a lot of people from making this investment. Okay, I knew somebody was going to ask that. Are there black REITs? Currently on the market, none that I know of, right? However, and I'm going to get into this in another class, what gentrification really is and how gentrification really works and why it's important to the urban planning policies and procedures of a municipal government. I'll get into that in another class. But the reason why, right, the biggest issue that our community has with gentrification is we don't get an opportunity to participate in the process. If I'm investing in a real estate investment trust, don't be foolish enough to think that a white-owned real estate investment trust isn't investing in property in the black communities, because they are. So guess what? If you're an investor, you are seeing the upside of their investment policy, their investment procedures, etc., etc., etc. Does that make sense? So you're still participating in the process and making money. Because remember, at the end of the day, the goal of investing is to maximize your capital appreciation while mitigating your risk to your lowest common denominator. Make as much money as you can while taking the least amount of risk possible. And I'm sorry, when it comes to investing, it is not about black, brown, red, or yellow. Everybody sees green. We are all in the business of green. And that business of green transcends skin color. Don't ever get that twisted. Because at the end of the day, you got to do what you got to do for your own personal investment policy and your own portfolio of investments. What's good for you? And if everybody collectively comes together and makes smart, diligent investments, then guess what? We might actually have enough dollars to come together and make real lasting change for our community collectively. Does that make sense? But first, you got to take care of your own house, your own portfolio, your own credit, your own investments. You got to generate your own passive income. And these are the realities. Now, with that in mind, the last thing I want to cover, I can't believe I got through all of it. I can't believe it. Okay, so the last thing I want to cover is investment policy discussions, right? What is an investment policy? What is your personal investment policy? Your personal investment policy starts with, right? It is the things that you are willing to invest in, right? It is the targeted rate of return that you want to see on your money, right? So first of all, right, you have to determine, right, what it is that your targeted rate of return is. How much money you want to make on your money every year. So if you say, I want to see 10% on my money every year, then you look for investments that will be able to generate that return for you. And you have to make sure you understand that what you're trying to do, right, is look towards your net adjusted return after taxes, after inflation, right? How much will be left over? How much money do I want to see? What is the percentage of return on my money that I want to see after taxes and inflation? The net adjusted return. And seeking investments that will generate you that. Right? So that's first. But then you have to understand, okay, with that in mind, what am I willing to invest in? Do I want to invest in technology? Do I want to invest in cryptocurrency? Do I want to invest in real estate? Do I want to invest in healthcare? You have to make that decision, right? But I will tell you this. Never invest in anything that you do not understand. And if it sounds too good to be true, oftentimes it probably is. See, so with this in mind, right, when it came to the Tulsa Real Estate Fund, if that's something you really wanted to do and you fancy yourself a savvy real estate investor and you just wanted to invest in a real estate fund, you know, you do the due diligence, you don't understand some of the terms, it's okay not to understand a word. See, because on Wall Street, we say all the time that we shroud our business in complex nomenclature. That sounds really complicated, right? But really all we're saying is we use big words to hide what we're really doing so the average people don't understand what it is that we do. So it's okay not to understand a word. There's dictionary.com. There's the sources online. If I don't understand a word, believe me, I'm looking it up. And when I learn what it means, I'm adding it to my lexicon of vocabulary. And I'm putting it to use. But if I don't understand something that I'm reading, it's nothing for you to go out and get a financial advisor and go look and ask, what does this mean? Most lawyers will consult you on small things for free. Like, listen, like asking questions. Never be embarrassed about what you don't know. Be embarrassed about what you don't know that you don't ask about, that you lose money because you were too embarrassed to ask for help. That's what you should be embarrassed about. It hurts to lose money. But the reality of the situation, a lot of this can be avoided if you're just willing to ask for help, willing to ask questions. Investopedia is a great place to look up different types of terms and things like that. And I'd highly recommend Investopedia for sure. At the end of the day, though, right, you know, I will answer any questions that I can for you. You know, I do what I do for free to help y'all out. You know what I mean? Raymond James is pretty cool. Mutual of America, Mutual of America. I think it's is it Mutual of America or Mutual of Omaha? It's probably Mutual of Omaha. But yeah, they're pretty good. But yes, Raymond James is good. You know, and look, most of you guys can open, you know, a trading account at TD Bank, you can, or TD Ameritrade, or Merrill Edge, Merrill Lynch. Like, these are all reputable firms that you can open accounts with. Like, so that's that. So at the end of the day, I covered what I wanted to cover today. So I want to open the floor up for questions. So that way, you know, we've got about 11, 12 minutes left here. Actually, probably more like 10. So I want to open the floor up for questions. Okay, Intelligent Investor is a good book that you should probably read. A Random Walk Down Wall Street is a book you should probably read. Security Analysis is a book you should probably read. Let's see. Yeah, that's a good start. Those books are good starts. So, but yeah, definitely start with Intelligent Investor. I think that's a good book that people should read. The Creature from Jekyll Island is a pretty good book. How long does Tulsa stay open? What do you mean by how long does it stay open? I don't understand that question. Can we talk about futures ones of these? So I'm going to do this every Sunday at 3 p.m. I'm going to come on and I'm going to, you know, talk about stuff. I don't have an answer to how much of the $9 million was leveraged for more capital for acquisition. I don't have an answer to that question because unfortunately they have not done a recent filing to disclose any of that. So I can't tell you that. What is the total amount of money TREF collected? Until they update their filing, no one knows. But it's got to be north of 10 million at this point. How is Jay getting away with this? That is a great question. So from an SEC standpoint, he won't be much longer. But from an SEC standpoint, when they investigated him, they only investigated the quality of his disclosure statements, and they found them to be sufficient enough for what he was doing. But they did not look at the quality of the business he was running or anything else. But remember, this is the same SEC that investigated Bernie Madoff like 4 or 5 times. So let's be very clear about that, right? So my confidence in the Securities and Exchange, the Security and Exchange Commission's ability to do thorough due diligence and look at everything, you know, but that's okay because there are other avenues. There are very much other avenues. The futures market. I won't discuss the futures market with you guys. Unfortunately, I just don't feel like overall, don't take this the wrong way. I shoot very straight and very direct and very to the point, right? I don't feel like the overall in general financial literacy level in our community is to such that I would discuss futures contracts, forward contracts, spot market trading. These are things that I just probably would not get involved. I like to stay with the basics and work our way forward from there, right? So we start with the basics, we get a basic understanding of things, right? And then you build, you get some practice with those things, and then you build upon those things, right? It's like building a solid foundation to build a solid house. That's what I believe in. When are there updated financial? Where are their updated financials? Aren't they due? I have to look at their filing date requirements. I haven't gotten that far. What are your thoughts on the Airbnb IPO? My thoughts are that most of you will not be able to participate in their IPO because IPO shares are usually, so there's pre-IPO and a cooling off period. And so how it generally works is big block shareholders come in and buy IPO shares or pre-IPO shares before the market goes public. And then what happens is based on analyst opinion, analyst run-up, and all of those things, the market drives itself, and then they usually sell into that market and drive it down a little bit. So the Airbnb IPO at this point, given what's going on with coronavirus, I have mixed emotions about that. So are there any other questions relevant to what we talked about today? Not to like kind of try to steer the conversation away from like IPOs and stuff like that, but that's IPOs and things like that are very complex discussions because you have to understand how an initial public offering is done. There are different types. There are best efforts underwritings. There are firm commitment underwritings. There are a number of things that go into that, is beyond the scope of what we're doing here today. So, anybody else have any questions? I'm going to save this, by the way. I figured out how to do that. I meant to save the last one, but honestly, y'all, I didn't really know what I was doing at that point. Instagrammed and upgraded and done all these cool, different, wonderful things, right? And me, unfortunately, I ain't know nothing about none of that. So, I ain't know what I was doing. So I had to Google it. You know what I mean? I had to Google it to learn how to do it. But I know how to do it now, so I'm going to save it. Is that it? Nobody has any other questions? What type of lawyer should I hire to read over contracts? A contracts attorney. This is the other thing I want to say. And while I'm on it, hire a contracts attorney. But here's the thing, right? Yo, listen. The biggest problem we have in our community, honestly, is that we look at the flash and dash and judge a person's veracity, credibility, or ability to execute and perform on that, right? Let me tell you something. Reality of the situation is this. Even if you have some sort of real estate experience, that doesn't mean that you are a real estate investor. And even if you are a real estate investor, that doesn't mean that you're a commercial real estate investor. Every industry has different facets, right? So you have real estate agents. They're good at listing homes, setting out some cookies, signing some contracts, and collecting a commission, right? And you have commercial real estate investors or real estate agents that are good at commercial real estate deals. They're good at selling real estate or representing someone to buy commercial real estate, right? You have real estate investors that focus on single family residential homes or 1 to 4 units. And just because they're really good at that and make a whole lot of money doing that doesn't mean that they are capable of doing something like, investing in commercial real estate. That's just a fact. That is just a fact of life. And so with that in mind, the jack of all trades is oftentimes the master of none. Let's be very clear of that. And so, you want to be dealing with people that are singularly focused and putting in the time and investment and resources into doing a thing very, 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 very well. And so that's that. Let's see. Somebody said go live with Tony, but is Tony in here? I don't know if Tony is in here. But so my point is, right? So my point is this, right? Be very careful. And I've got about 3 minutes before this is going to be over. Do you know of other companies with the same business model as TREF? Yes, they're called Real Estate Investments Trust. I covered that earlier. Let me see. Do you feel Jay was trying to do a legal scam on the black community? First of all, he's not only doing a legal scam, there are several illegal aspects to this, but I can't disclose that right now because I'm in the middle of getting that looked at the right way to make sure that this motherfucker pays. So I don't want to disclose my hand really at this point. You know what I mean? I really don't want to disclose my hand at this point. But understand, it's going to be smoke. He going to get that work. You believe that. He going to get that work. So, pay consultants. It's a tax write-off. If it's done under an LLC, generally you are correct. But yes, the net effect is everything that glitters is not gold. Do not let the flash and dash fool you. I don't give a fuck. Boyce Watkins came out and stamped this Tulsa real estate fund. Let me tell you something. Just because Boyce Watkins know a little bit about financial advisory or whatever, or economics, that doesn't mean he's a fund manager. That nigga never worked on Wall Street. The hell? How you gonna stamp something you don't know nothing about it? Be careful with that. We tend to make the mistake that because a person knows one thing about finance, that they're the end all be all subject matter expert to finance. Or because they know one thing about real estate, that they're the end all be all subject matter expert to real estate. Or just because they're a lawyer, they know every single aspect of the law. That is not the case. People focus on specific things. But guys, listen, I gotta go because I got 23 seconds. It was a pleasure speaking with everybody. I hope that you guys enjoyed this, and I will be doing this every Sunday at 3 p.m. Y'all have a great day.